We're finishing off a big earnings week and looking ahead to another big one next week. Joining us right now on the key names that she's watching is Kari Firestone. She's co-founder of Aureus Asset Management, also a CNBC contributor. And Kari, it's great to see you this morning. What do you think of earnings overall? Because it feels like there's been some positive stories, maybe a few disappointments too. But what's your general take so far?
Hi, Becky. I think earnings have been better than expected. There's been a real underlying tone that a recession is coming in this market downturn because of the tariffs and because of just unease. But earnings have been reasonably good. A great example of that, of course, would be the Alphabet earnings last night, Google, which came in as expected. Very good numbers, 12% revenue growth, 10% up on search, YouTube. The cloud business was up 28%. Margins are improving. They're buying back stock. That's very reassuring to the market. The market for the last few days has really driven higher on the back of these tech names. And more of them, of course, Microsoft, Meta, as an example, Amazon, reporting next week. And the reason, of course, these are so important, if you just look at the revenues of Alphabet, just one company, Alphabet, they are the equivalent of the airline plus film plus footwear industries in the entire United States.
Wait, say that again. The airline plus film plus...
Airline plus film plus footwear.
Wow.
For the whole United States. You could have substituted the cable industry. Oh, I don't want to minimize cable because of Andrew's ward, but these are very big industry, 90 billion a year in cable, 90 billion in footwear. But those three industries fit into, one company, Google. And therefore,
wow.
it drives the economy. They drive the economy. I've said before the top two names and the S&P, whichever two they are equal in market value to the bottom 300 names in the S&P. So, better, like it or not, these are the companies that have, driven this U.S. economy forward. And even if they take apart Google, and there's a discount to Google, of course, because of that, we would think, they all matter. All the pieces matter. So, yeah, thank you. Thank you, Alphabet, for having a good quarter. And otherwise, I think this would have been a tough day today because advertising, if it were down, would be, or weaker than expected, would really be a sign that advertisers are worried, worried about spending money, worried about the consumers.
Well, that was the fear heading into it. We did speak with an analyst yesterday who said that this was going to be a very scary week because of what we could potentially hear on that advertising front, just in terms of an indicator of a broader economic measurement on these things. So Google paying off here. I know you've been adding to some other names, too, Applied Materials. Why do you like that stock?
Well, that's a name that we hadn't owned. We hadn't owned it because it had, ridden up so much all of the semiconductor or semi-cap equipment makers. Now, this is a business that it was cut in half. The stock down 50% when we bought it. So we decided add it. And you can't build AI even if they delayed production of certain chips. Can't do it without having the equipment to make the chips. And the chips are more complicated, considerably so, than they used to be. So, AMAT is one of the leaders in the industry. And we didn't own the stock, and it was a great opportunity.
Well, also, Andrew pointed out before, Alphabet saying that it's going to be spending so much more in CapEx this year as well. $75 billion, that's got to be reassuring to the rest of the infrastructure or the rest of the ecosystem around those chip stocks, too.
Yeah, exactly. We added some Microsoft. Microsoft has been one of the underperforming names of the Magnificent Seven, even before they started to go down. Microsoft has the balance sheet. It's U.S.-centric in that they don't need to import a lot to build their software. That's ubiquitous. It doesn't really need the physical logistics of it. And it's a subscription model. Again, stocks underperform. The multiple has come way down from the 30s and 24 times. So that was a huge balance sheet. American Express really got hit recently because of fears about consumer spending. They seem to be holding up. Employment definitely is holding up. Even if we had a mild recession, Amex continues to gain market share, and the multiple, which had got a bit expensive, came back down. So that was the name we added. Another name we think we like, which is a bit controversial, would be Thermo Fisher. This stock is down over 30%. There's fears that because of both tariffs and cuts in spending about healthcare, that's going to hurt their business. That business has already been hurt, and it's been depressed post-COVID. The management has been upfront about saying that there's going to be some pressure on revenue and profit this year, but next year it's going to start to improve. And that's a way to play the potential increase again in spending, which has to happen in order to develop new products, which this administration is going to be positive about. I mean, despite what they're saying about cut, there's got to be spending in order to have innovation.
The only thing I'll bring up with that is we've had Scott Gottlieb, the former FDA commissioner in the first Trump administration, who has said some of those cuts that they're talking about, the DOJ cuts at the FDA, are impacting areas within the FDA that would be responsible for approving all of these things and helping manufacturers figure out more quickly how to produce drugs or any of the other points along the way for anything that Thermo Fisher would be producing too. If you have cuts to those policy divisions that really acted as things to help speed along innovation, what does that mean?
There's definitely going to be some slowdowns in the near term. And, we would advise and encourage them not to cut the FDA in order to keep things moving. However, that's in the stock. I mean, it's a bit like why the market has been going up this week. You take a market, drop it 20% because of fears about tariffs that may or may not happen, and I'm sure some of them will. But that was an overcorrection. And in the case of this company, it's been overcorrected based on fears, some of which may come true, but that's already priced in. That's what's important about this kind of market, Becky. Remember, during COVID, in February to March of 2020, that was the drop of 32% in the stock market. And then the market started to go higher. And we had not seen anything about what was going to happen during COVID, as that was a week after it ended. The decline ended a week after people were asked to come home and stay there. So well before we saw any economic impacts, the market began to go higher. And that is something you always have to think about in market declines. Where is the opportunity?
Kari, let me ask you just where we stand in terms of the opportunity in the market, how it's priced for the tariff discussions, tariff war, whatever you want to call these things. You're right, 20% looked like a pretty extreme sell-off. That's where we got with the S&P, but now we're only down by about 10.5%. Is that fully factoring in everything that we're seeing right now?
So that's the ultimate question, and I was talking about that last night. We know that the market, or we felt that the market was a bit pricey at the end of the year. The multiple of the market was 22.5 times next year's earnings. Now it's 18.5 times, assuming there's not a big recession, of course. So we have removed, we think, the excess based on how expensive the market was before. But have we already priced in tariffs of, let's say they're 10%. Is that in the market? Is it 5%, 6%, 7%? It's somewhere in there. So the market is not far from where we would believe is an appropriate level given a certain level of tariffs. Is the recession priced into the market? Perhaps a slowdown, maybe not a recession that's deep. So I would say, we're thinking this is a fairly valued market right here, but some of the market is very attractive because of the pricing action that we've seen as just companies have gotten hit. But we're not, as you've suggested, down 20%. The market has come up 10% from the low. Year to date, down 7%. And where would we feel the market can end the year? Probably not lower than this. So if you have an opportunity to be a long-term investor, yes, I think this is a reasonable place to enter the market here.